Welcome to my channel. I'm Dr. Romano. When we talk about who is a trader and the profile of a trader, we're going to discuss who would be the best fit to be a financial trader. I'm not sure if you know my business, but I started off on the trading floor of an investment bank in the late 1990s. I know I look young, but I'm not. That's a trick. So I guess I have good DNA. So the investment bank traders are different as opposed to the hedge fund traders, as well as people who are trading in the industry, whether they're trading the currency or on the stock exchange or on the NASDAQ or whatever it is, commodities market in Chicago, whatever. So I'm going to go explain to you what would the best fit be. Now, I don't want you people from HR at the investment bank or at larger hedge funds to use this as a way to search for new traders. You don't use this to search for traders. Doing psychological tests for stress, or as well as personality fit, all those tests are not going to give you who would be the most successful trader. Now, the only way you're going to know that is looking at a track record. And some people, they do that and some people don't. Now, I'm going to first explain to you at the investment bank, how do they find and recruit new traders? So the first thing is that HR goes to the universities and they look for applicants and they recruit from the top 5 schools, basically, the top 10. And those are typically Ivy League. And they're looking for students who have perfect grades, the perfect resume, so to speak, maybe a dominant trait in their hobbies or other activities that they have done, maybe sports, as well as maybe being the president of the high school or whatever the criteria is. However, that type of criteria is not someone who is going to be a successful trader. Now, yes, students that are polished, that are from Ivy League schools, they will do really well on standard testing because they have a short-term memory, a huge short-term memory, which allows them to get high grades. Has nothing to do with studying. Those students that have a really good short-term memory, they don't even have to look at the book. They just have to listen to what the professor says, and they will recite that in a test and get 100. Now, as well as in high school, they're going to take the entrance exam to get into a university, and yes, they're going to get a really high mark. In turn, they're going to apply to really good schools, and they're going to go to those Ivy League schools, and then they're going to get recruited from at the investment banks to land their first job. What I want to discuss is recruiting young students or graduates from Ivy League schools and giving them a chance to be an assistant trader. They're taking a really big chance, the investment bank, to do so. I know it's very hard to recruit traders, and that's one of the methods that they use, or they will try to recruit traders from other investment banks and bring them on board. But you have to remember, just because someone is a trader at another investment bank, that doesn't mean that they're bringing value or a substance or some sort of creativeness. Because remember, the people that are going to the Ivy League schools, as well as the top students, they're very articulated when they speak. The vocabulary, they have an intrepid short-term memory to remember that vocabulary. When they produce emails and write emails, they're very articulated in their sentence structure. And so all of that is part of being polished as a student. But not everyone is going to have those qualities that do have a possibility of being successful as a trader. Now, one of the reasons why investment banks are basically not as profitable as a hedge fund is because the hedge fund, most hedge funds out there are not looking for traders. Most hedge funds out there are actually traders themselves that have a track record, and somehow they are able to raise capital based on their returns. So if they're not producing the returns, they're not going to raise the capital, or sometimes they have a really good buddy at the investment bank who will hook them up with the correct person who will help them raise capital. But their returns may be very low or just not what I call quality. It has nothing to do with the actual amount, the number amount, whether it's 2% or 50% return on a yearly return. It has to do with something else. I will get into that into other videos. I can't discuss that right now. I just want to tell you who would be the best fit as a financial trader. So those of you out there that want to be a trader, what I suggest is don't try to get hired at an investment bank. Don't try to go to the best school. What you need to know is, number one, is you need to know the history of the financial stock market. There's correlations that happen. And once you know that, you could use that to your advantages. Now, in my case, I have an intrepid long-term memory, as well as I'm highly visual. So that's an entrepreneur. That's someone who takes big risks in starting new businesses, wants to perfect a particular strategy. For example, I used to work for the investment bank on the trading floor in risk management for the chief financial office. And I seen that the risk measures back then were very outdated. And I kind of couldn't understand why risk management was meeting with the head traders and the trader themselves when their books were overexposed. It was very elementary to see that. It's their responsibility. They should know how to manage their risk as a trader, because part of trading is knowing how to manage your losing trades. That's the basic gist. And that's risk management, how when you're going to get out and so forth. Your winning trades, you're going to win, doesn't matter. They're green. It's those bad trades that are red. It's not that they're always going to be bad or losing trades. It's just that the market's going in the opposite direction and they're red. In other words, they're overexposed or that you're losing a lot. But most traders, every time they get into a trade, they know that number amount that they're willing to put up to to trade for that position. And because of that, once that value is too much, then it's time to get out or do something else to get out of your losing trades, maybe buy a put or a call, etc. Now, that was the main issue that I started my PhD, because I was very disgusted at the investment bank level who was trading and the awfulness of the quality of the returns. They were very watered down. And I knew that only, 5, 6 investment banks were around back then. And you can't have 5, 6 investment banks, or even 10, the only ones on the markets trading, because those positions that they're trading with are huge. And think about the clients that they have that are also trading. So I knew that was very, very, it creates a choppy market, in other words. In other words, it kind of creates those little traders out there that are trading, day trading, etc. It doesn't allow them to be proficient at what they're doing and make profits, because the larger traders are getting in and out and they're causing the markets to go skyrocket in just one investment. Whereas, they could handle the ups and downs, but the little guys, it's a lot of money that they could lose, etc. When I was on the trading floor, I saw all that. I knew the history. I would ask a lot of questions. And because of my job, I was the one who would review the trading books on a global basis every morning. And I noticed that there were certain traders that were making money and certain just weren't. Their returns were really bad. And I couldn't understand that. If they went to Ivy League schools, they're smarter than me, you know? They know more than me. They're so articulate with their vocabulary and the way they create their emails and so forth, and how fast they learn. That was the problem. The problem is that the hedge fund traders, they're not all from Ivy League schools. They're not all from investment banks. Some of them are, some of them aren't. Believe it or not, some of the top 10 hedge funds out there weren't, they were just anyone. And there was a study, not really a study, but it was a bet by two guys in the 1970s, 80s, late 70s. And I know this because a friend of mine is part of the story. And so basically, and there was a movie created about that called Trading Spaces. And the bet was the actual trader, Richard Dennis, mentioned that trading is an innate ability and you have to have it within you. You're born that way to be successful. What he was saying was actually true, because you have to have the mind of a trader, right? You have to have the ability to see correlations, as I do. Now, I'm not here to sell you trading advice. I'm not here to raise capital to start trading your capital. I'm simply here creating a video on YouTube that discusses the profile of a trader. And so I'm walking you through the different logical mind that I have and the examples. So Richard Dennis said it's innate, you're born that way. And then his friend at the bar was a mathematician, doctor, I can't remember exactly. Yeah, he was in math, I believe. He was in math, and he said that you have to be taught how to trade and that you could teach anyone. Because Bill Eckhart's mind was mathematician, mathematics, and that's a yes or no type of mind. See? So people who have a yes or no type of mind, they do really good with computer programming, good with policing, good with electrician, plumbing, etc. And then they looked at my friend Lucy and they said, well, let's teach her if it's true. And so they bet, whatever, they made a bet. And it turns out Lucy actually, she became very successful on trading at that time. And what was really interesting was, she was female at a time when there was really no females as traders. And it was very limited. And back then, the females were the secretaries, and the men were the traders, the stockbrokers, the directors, etc. It was very limited, and it was a very closed and time period. But after the mid-1980s, that started to change. I don't know if you know your history like I do, but the women started to advance in their careers. They were no longer just a housewife. They were going to school a lot more. There were a lot more women in school going and studying finance. Now you have to remember the social norms had changed in that time period. It wasn't just that women weren't capable. It was during that period that each person had their own path in life. And so it depends if you're a man or a woman. If you were a man, you went for, let's say, construction and finance. If you're a female, you went for education and nursing, etc. But that changed now. That was in the late 70s, 80s, that change happened. And so Lucy started trading. They put her in her room and they taught her the strategy. And it turns out she was actually very successful at that time. She had no college degree. She was not... She was maybe articulated the way she speaks, and her memory and what she knows and what she can learn, because she's that type of personality that you could basically teach her anything and she'll be very successful at it. And whatever she likes and that she's drawn to, I know her personally, by the way, whatever she's drawn to, she becomes proficient at it. So based on her personality and her personality traits, she's a good fit for a financial trader. But they didn't know that back then. And so after that, they put an ad in the newspaper. I can't remember if it was the New York Times or the Wall Street Journal, but a lot of different people responded to that ad. And I believe they brought in 30 people from all walks of life. Some were math doctors, some were financial doctors, some were school teachers, someone was a policeman, a plumber, electrician, you name it. It was from all types of, people. But the people that were responding to that type of ad were risk takers, and they were the entrepreneurs. It's that type of mindset. Because if you respond to an ad in a newspaper with no one's name, and you're like, what's this? Is it true? They're really going to teach you? But the person that's an entrepreneur, they're willing to learn. They have that ambition. They have that intrepid drive to learn, no matter what it is. That's part of being a trader. Because a trader, if you want to go out on your own, you have to perfect your trading strategy. 2, if you want to be better at that, you have to continually tweak your risk management and your trading style. Because sometimes today's one strategy may not work in a couple of years. So you have to continually be that inventive type, as an inventor does, to continually improve your risk management and your trading style, as well as continually find new ways to make money. Now, out of those 30 people or 27 people, whatever that number was, there is 1 or 2 people that are at the top 10 of the hedge fund industry. I can't tell you his name, but he's definitely big up there. He's one of the top 5 hedge funds concerning AUM, capital under management. And what's really interesting, I studied his personality in various videos and just the way he thinks. He's that type of person. He's an entrepreneur, number 1, and he's always looking to improve his knowledge and education. Now, Lucy, on the other hand, is also always improving her knowledge in whatever she touches. She's an amazing person. Part of when I was completing my PhD at that time, she was very helpful in helping me increase what I needed to know. And so she was referring me to different traders, and that was different hedge fund managers at that time. And she had such an incredible wealth of knowledge that she knew. And I want to thank her for all her help, as well as the person who put me at the investment bank. That was a very incredible person, also a entrepreneur type of personality, a person that never stopped with education, a person that always wants to perfect what he's doing. And that's why he was a trader. And so I want to thank those 2 people, Richard and Lucy. And part of this video is making that video for them. Now, next is the top traders out there. And so, yes, there are people that come from investment banks that become very successful at traders, but they're just, their brain, their logicalness, their visualization, and their short-term memory and long-term memory may be equal. And they may be they have maybe charisma that allows them to increase their AUM. For example, Bernie Madoff. Bernie Madoff was a perfect example. Bernie Madoff could not trade to save his life, all right? Not even invest money. But he was good at raising capital. When he spoke, his facial expressions, everything, tone of voice, it put into your mind on a subconscious level that person was capable. Now, that also plays a role in having charisma. For example, all right, so Bill Clinton, when he would say a speech, he was smiling, and it was almost like you didn't believe him. George Bush. Now, these are big people out there that have a lot of money behind them that should be teaching them how to do a speech. George Bush is telling us we're going to war at 9/11, and he's smiling. It was like he was joking when he said it, but I know he wasn't in real life. As well as Bill Clinton, he wasn't joking in real life, and he was serious, but his facial expressions weren't within line. That when you're giving condolences, let's say at like a funeral, you can't smile and say, I give my condolences. You can't do that. You have to, relax the facial muscles in the face, and you have to relax and you say, I give my condolences. And then you pause. Now, I'm not perfect, but I studied articulations and speech communication in college, so I remember that course very well. And sometimes I actually smile when I say things that, I shouldn't be smiling, but it's my facial muscles, they're very tight. And plus, I'm a very happy person. I wake up happy. I have no reason to be happy, but I do anyway. And so I want to continue on all of that. So Bernie Madoff was a fraud. Yes, we all know him. He was not a hedge fund. He couldn't even trade. But he had that incredible charisma that when you saw him on the golf course, you would go up to him and ask him for stock tips. You should know immediately if you're asking someone for stock tips, they don't know what they're talking about. Because about time you know about it, it's gone. I mean, in the case of Bitcoin, I remember talking about Bitcoin and saying it was going to be something really big in 2014. And Lucy had purchased the institutional trader magazine for me for my university graduation for my PhD. And I seen Bitcoin on that cover, and I had money, 10,000, and I wanted to invest it. And of course, what did I do? I told my friend about it, and he started screaming. He goes, don't do it. It's the worst thing. Well, right after that, it went up. So I could have made a fortune. I would be worth $1 trillion today. But because of my thinking and the way my brain works, entrepreneur, I seen quality in that. I saw the coming of it. I'm sure many other people did too. But I seen the fact that not just people would be investing in it, but governments as well as companies. I seen all that. And I feel really bad that I didn't get in back then. And, that was my story. But I'm an entrepreneur. I'm always taking chances, establishing businesses. And I'm not afraid to, put up whatever money. And, for example, my first business that I started, it did really well. Of course, I sold it. But I felt very sad that I had to sell it. But it was time to move on to the next one. And now the second business is starting. So I'm going to be making a video on how to do that as well, but not right now. I just want to continue on what is the profile of a trader. And so it's that entrepreneurship and ability to always change for the better. Because people who are fixed, you can't be a trader and have that type of fixed personality. You won't be successful. I'm sorry. If you want to be a fixed personality, become a policeman. Those are yes or no. Become a person like a math professor, or become someone that does electrician. That type of personality is fixed. Your personality, you have to have the ability to always change and improve. Always pick up that book. Just because that guy in the book didn't work for the investment bank, it doesn't mean that's not value. You read it, try to understand where he's coming from and how he developed his trading concept, And from there, you improve yours. So that's what I did. When I was completing my PhD, of course, I knew what I was doing because I wanted to become the doctor of hedge fund selection. Since the year 2020, no, I'm sorry, the year 2000, I knew that that's where I was going, but it took a long time to get there. I had to get my MBAs, I had to get a PhD, I had to do research, I had to write books, etc. And after my second book, which is not published yet, I understood the profile of a trader and what that personality, how that personality is going to produce those quality returns. Because remember, the industry right now, they use certain type of risk measures to select a hedge fund and deselect a hedge fund. Those risk measures are very outdated, and in my PhD research, I proved that they're outdated and they're not, that's not a way to select and deselect a hedge fund. Very simple. I'm not going to get into that right now. But the point is that I seen at the investment bank what the actual profit and losses of a trader, the trading books look like for certain traders. And when I seen that in the data, I realized why. But then I realized with the actual traditional risk measures, those type of traders are not going to be selected for a hedge fund or to be a trader, because their returns are not within line within what the industry wants. So again, selecting a hedge fund, you can't use that traditional method. That's totally outdated. And so I had to create my own, and I had to prove it with data. So that's what I've done. And so once I reviewed, I saw that in the data for hedge fund returns, because my research is using hedge fund data and stuff, I realized what that type of personality was. And it was amazing. It was a personality. It wasn't just someone who went to an Ivy League school. It wasn't someone who went to an Ivy League school. It wasn't someone that was very successful with management. Remember, the investment bank recruitment process, the way they're recruiting is what they're looking for, and what they're finding are managers. Someone who's very articulate, who could produce a really good email, someone who could go to a meeting and recite what goes on to the next meeting. That's a manager. That's not a trader. And so another reason why the hedge fund industry is now becoming so much more than it was 20 years ago is because the investment bank realizes their recruitment process is not working. They're not able to find those traders that will become successful. They're just facilitating what the company needs and the day-to-day tasks. That's it. And so after the mergers and acquisitions of the 1980s and 90s, the investment banks kind of plateaued. They could no longer find ways to make more money and to become profitable because they were so big that the only thing they could do is buy out another bank, or that's it. And of course, when you only have a handful of banks, what happens to our financial markets? It's really bad, because you have the big banks investing in exactly all the same type of products. For example, the mortgage, those mortgage securities, that was really bad, and only Bank of America back then, of 2008, really didn't invest heavily in that, or they sold it before the collapse. But the other banks, such as Bear Stearns and AIG, they really invested heavily in that because it was profitable and it was risky. So risky means you're going to make more money. But whereas Goldman Sachs, you would think that they knew that with all those sophisticated people that work there, but they didn't. And that's another reason why, once the owner of the company dies and management takes over, the quality of the product, the company becomes diminished. And because of that, you had so many people were laid off because of the mergers that happened. You had thousands of people that just had no jobs overnight when two banks merged together. And so that's why more people open their own businesses as a hedge fund or whatever they were doing. But those people who were traders, they went on their own, or they went into teaching or whatever they did, or other careers. And so that's what kept increasing the hedge fund industry. Because just because someone's really good with trading, it doesn't mean that they're going to get recruited by the investment bank. So what do their alternative is to trade for themselves. Then once they have a track record, let's say 5 to 7 years, then they have proof that they're making money and they have really good returns, then they could raise capital and become that hedge fund and continually grow. Of course, not all the big hedge funds out there have the best returns or the best profile of returns or profile of a trader. No, it doesn't work like that. Some of them are really good with raising capital, but some of them aren't. They don't have charisma. For example, think about when you're raising capital as a hedge fund trader. They're going to want to know what your strategy is. They're going to want to know the markets, the whole spiel. Now, a really good hedge fund manager is not going to tell the clients what their actual trading strategy is. That's his or her niche and ability to make money. They're not going to give that away. So when an investor asks a hedge fund, well, what's your strategy? They're going to tell you what they want you to know. And they're going to tell you the sophisticated version that's so, oh my goodness, you can't even ask questions because you don't even know what they're doing, what it means. And so that's how they're able to push it along to get rid of that question. And that's another question as an investor. If you're looking to invest in hedge funds, don't even bother asking them their strategy. You read their fact sheet and that's all you could really. You don't go interviewing them and looking at their personality or your subconscious ability to think that they can make money or not. No, don't put your insecurities in the way when you select a hedge fund. And the only thing that you could actually really follow is their returns and their ability to trade in different markets and your knowledge on which market to be in at that time. That's the only thing that you should be focused on. Now, and it's coming from me because I'm a doctor of hedge fund selection. I'm the person that created my own theory as well as my own strategy on how to select a fund. And so I'm the one that knows the profile of a trader because I've done so much research on this. I could basically walk in a room and I'll know exactly who would be a really successful trader without even looking at their returns or just by their personality. And I don't want to give too much away in these videos, but there's a lot more to it that I really can't mention. And that's the gist of it. So for those of you who want to be a trader, do not let anyone stop you. You must try it. You must read all the books, everything, and keep it up. Keep your strategy up to date. Continually tweak it, as they say in the industry. I call it improve the strategy. And you will do very, very good. So basically that's the gist, and I want to thank you so much for watching. Please remember to subscribe to my video if you want to see future videos, and please remember to thumbs up so that other people get to see my videos, and share my video with at least 5 people. And finally, if you have trading questions or any questions, send it to the live chat and I will make future videos just for you. I want to thank you so much for watching.